Hello everybody, it's Yashar here, back again with another video. And in this video, I will diving deep into one of the most influential companies on the planet, Google, which has a market capitalization exceeding 2.3 trillion US dollar. When we talk about Google as a stock, we have two groups of investors and analysts. On one hand, we have some investors who believe Google moat in search is going to decline. Google is a dying business. They are behind in AI technology. They were too late in cloud competition. AI browsers like Perplexity Comet will take market share from Google Chrome, and Tesla will be much more efficient than Google in self-driving technology. So owning Google is like choosing Intel over Nvidia or AMD. We also have a second group of investors who believe that Google is so cheap and undervalued that it is offering a generational buying opportunity at the moment. I will look into arguments of both of these groups and will value Google stock based on two different techniques. First, sum of the parts or breakup analysis, and second, discounted future earnings model. And we will see which group claims are based on the facts and data. Of course, I'm going a little bit beyond just the numbers today. I will explore the key pillars of Google's business, its dominant search position, their massive advertising business, the explosive growth of Google Cloud, and the power of its AI models, particularly Gemini. Let's start with AI. The buzzword dominating tech right now is AI, and make no mistake, Google is at the forefront of this revolution. The CEO of Google, Sundar Pichai, has consistently emphasized AI as the most profound technological shift, and Google's strategy reflects this. So let's first talk about Gemini. This is Google's flagship large language model, a direct competitor to OpenAI's GPT models and Meta Llama models. We are seeing Gemini integrated across the board in search, Google Workspace, like Gmail and Google Docs, and even YouTube. And developers are building applications on top of Gemini. I personally building all of AI functionality of my own software for stock analysis on top of Gemini at the moment. With the new upcoming update of Gemini, we will see breakthroughs in performance and some new features like turning photos into video clips with sound. After Gemini, let's look at other AI initiatives of Google. So the most important one after Gemini is AI overviews in search. This was a game changer. AI overviews provide summarized answers directly in the search results, now reaching over 1.5 billion users monthly. This isn't just about convenience, it's about making search more powerful and responsive. Google is already testing how to integrate ads into this AI mode, which could open up significant new revenue streams without disrupting the user experience. Next, we should talk about AI infrastructure. Google is investing heavily in its own custom AI chips, like the tensor processing units or TPUs. Their 7th generation TPU is called Ironwood, and it is the most powerful hardware enabling faster and more cost-efficient AI training and inference. This vertical integration is a massive competitive advantage for Google, allowing them to optimize the performance and control costs in this such a capital-intensive domain. And the last but not least, I can talk about agentic platforms. Google Cloud's agent space is a prime example of the focus of Google on AI agents. Systems that can combine AI models with enterprise data to automate complex tasks for businesses. While AI might be the future, advertising remains Google's present and primary cash generator. In Q1 2025, Google's ad revenue hit $66.9 billion, which was an 8.5% increase year over year. Basically, it's now making up over 3/4 of their total revenue. So with advertising, let's first talk about Google Search. This is the bedrock, bringing in $50 billion in Q1, up almost 10%. The dominance of Google Search, which right now holds almost 90% market share, means advertisers have nowhere else to go for such a vast reach and targeting capabilities. AI, in my opinion, is only going to enhance this by improving the ad relevance. Next, we should talk about YouTube and YouTube ads. YouTube generated $8.9 billion in ad revenue, which was a 10% increase year over year. YouTube's growth, particularly in areas like short monetization, continues to be a strong story for Google. The platform's massive user base and increasing engagement make it just another vital platform for advertisers. While there are ongoing antitrust concerns that could impact their ad business, and I will talk about this more in the next part of the video, I don't see any real data that suggests Google dominance in search and advertising is declining based on these numbers. We should actually look for the next quarter earnings report, which will coming up soon. Next, we look at growth engine of the Google business right now, which is Google Cloud Platform. In Q1 2025, Google Cloud revenue surged by 28% year over year to $12.2 billion, with operating margins improving significantly to 17.8% from 9.4% 1 year ago. This shows a clear path to profitability and also the scalability of the business, which is great. Google Cloud operates in a very competitive market, primarily against Amazon Web Services or AWS and Microsoft Azure. AWS is still the market leader with almost 29% market share. Azure is the second place with almost 22% market share, and Google Cloud is the third place with almost 12% market share, but it is rapidly gaining some ground. One of the main advantages of Google Cloud is to utilize Kubernetes. Google itself created Kubernetes, and its managed Kubernetes services is considered the best in the class. You may not have heard about Kubernetes before, but any company that tries to build software using containers, probably using it at some point. Containers are basically a package and application and all its dependencies like the code, the runtime, the libraries, the configuration files, everything into a single isolated unit. This ensures the application runs consistently across different environments for development, testing, and production. And Google Cloud is the best in the class to implement container applications on Kubernetes. The last but not least, I want to quickly look at Google's other bets. Right that this section of the business only makes close to $500 million annually, but some of these small bets can actually become a much larger part of Google's revenue in the future, particularly Waymo, which is just started scaling and it is on its way to take market share from Uber and become profitable in the future. Waymo is currently the leader in the development and deployment of self-driving cars with LiDAR technology, which seems to be pretty safe and smooth based on the feedback of the people who use Waymo. And the videos basically I watched from Waymo rides. It is crazy to think that they were able to beat Tesla in autonomous driving game. When Tesla was advertising this for the last 5 years, Waymo silently developed technology and basically they were testing these vehicles on the road. Waymo says it has recorded more than 10 million paid rides. Waymo has done over 33 million autonomous miles across San Francisco, Phoenix, Los Angeles, and Austin. While it is not profitable yet, Waymo is currently valued at over $45 billion. Here I'm even not counting the other small bets that Google is working on, like GV, which is the venture capital arm of Google, investing in startup tech companies, Verily, which is the Google bet on life science, and it is creating advanced devices for health monitoring, like smart contact lenses for glucose monitoring. And for example, we have Wing, which basically a Google company which works on drone delivery services. Any of these small bets can become the next Waymo or Google Cloud, but we never know. So when we want to analyze Google stock, we should disregard these bets at the moment, but there is some potential. Okay, let's focus on Google antitrust cases. This definitely remains a key risk to investing in Google. Regulatory bodies worldwide are examining Google's market dominance, particularly in search and advertising. In the United States, the US Department of Justice or DOJ has brought 2 significant antitrust cases against Google, both of them which relate directly or indirectly to Google dominance and its impact on the competition. One case specifically targets Google advertising technology. The other one more broadly focuses on its search engine monopoly and includes Google Chrome as a key element in maintaining that monopoly. So the lawsuit claimed that Google pays billions of dollars, which is in reality more than $25 billion annually, to companies like Apple and various Android device manufacturers to make Google search the default search engine on their devices and browsers, particularly Chrome. The DOJ argues that these exclusive multi-year contracts lock out rivals and prevent them from gaining a foothold in the search market. By making Google the default, the users are less likely to switch, which reinforcing Google's search monopoly. Following a federal judge ruling in August of 2024, Google indeed violated antitrust laws by monopolizing online search. The DOJ has proposed significant remedies to break up this dominance. There are news about some drastic proposals from DOJ which directly involve Google Chrome. For example, ban on default search engine deals, or requiring Google to share some certain user data with competitors to level the playing field. But the most radical proposal is to break up Google and sell Chrome to an external company. Google has consistently counters these claims, arguing that its market dominance is a result of consumers choosing Google products because they are superior and innovative, not because of the anti-competitive practices. They also mentioned that users are free to change their default search engine to browse to any browser they want at any time. They also mentioned that the proposed remedies are radical, overboard, and would harm American consumers and undermine US competitiveness in critical areas like AI. They're also arguing that breaking up Chrome would disrupt a complex ecosystem and potentially compromise user privacy and security, which I agree with the Google stand here, actually. But anyway, a ruling on the remedies is expected in August 2025, so we cannot be sure about the results until then. But Google has stated that it will appeal the decision on monopolization and any remedies imposed. So, as you can see, there are definitely some risks that can affect the future of Google, both from these antitrust cases and also from competition from AI companies like OpenAI and Perplexity with their new browser. On the other hand, there are some interesting potentials with Google Gemini, with Waymo, with Google Cloud, and their other small bets. In this video, I will use two different methodologies to evaluate Google stock. I will first use some of the parts model, and then I will use my personal discounted future earnings model to see what would be the fair market value of Google stock. And I try to consider both bear cases, where Google moat is going to be hurt and they will lose market share, and also the bull case, where the antitrust cases can be resolved with minimal damage and Google can keep its market position and create new revenue streams via its small bets. Okay. First, let's focus on sum of the parts methodology. Sum of the parts stock valuation or breakup analysis is a valuation method used to determine a company's intrinsic value by evaluating each of its individual business segments or assets separately and then summing those values. This approach is particularly useful for complex big companies, conglomerates, or those with diverse business operations that might not be accurately valued by a single consolidated valuation method. The core idea behind sum of the parts method is that the total value of the company should be equal to the sum of the values of its distinct components if they were able to operate as a standalone entity. Usually companies with diverse business units trade at a conglomerate discount, meaning their market capitalization is less than the sum of their individual parts. So sum of the parts analysis help to identify if such discount exists and quantify that. Since each segment might operate in a different industry with unique characteristics, you will need to choose the most suitable valuation method for each individual segment. Okay, first, Google has no net debt and they actually have net cash on the balance sheet, which we should take into account. The net cash for Google is $66 billion US. Okay, this is the first part. The second part, let's look at Google search. So they had $50 billion in revenue in Q1 2025, so they should be able to do approximately $200 billion annually. Meta is a similar company to this part of the Google business in advertisement. Based on price to revenue of Meta is currently traded at a 10 price to revenue multiple. Because Meta is still growing faster than Google, I assume a price to revenue multiple of 5 for the bear case, where there is little growth for Google, and 8 for the bull case, where the business can still grow its revenue but slower than Meta, which I think is reasonable. So, based on these assumptions, Google search in the bear case will worth almost $1 trillion, And Google search in the bull case will worth almost $1.6 trillion. Okay, next part of the business is YouTube. They earned $8.9 billion in Q1 2025, so they should be able to earn almost $36 billion annually. As the best video platform in the planet, I think comparing YouTube to Netflix is not out of realm of possibility. Netflix is currently trades for a price to revenue ratio of around 13. Again, Netflix might grow faster, so conservatively I gave YouTube a price to revenue ratio of 5 in the bear case and a 13 in the bull case to match Netflix. Okay, so YouTube in the bear case will worth around $180 billion. In the bull case, YouTube will worth around $468 billion. Next, we have Google Network, which refers to the revenue generated from ads displayed on third-party websites and mobile applications. This part did $7.2 billion in Q1 2025, and I think it can earn $28 billion annually. Again, I use Meta as a reference here, therefore, Google Network in the bear case will worth $140 billion. Google Network in the bull case will worth $224 billion. Next, we have Google Subscriptions, Platforms, and Devices, which earned $10.3 billion in Q1 2025, so it should be able to make around $40 billion annually. This part of the business should be similar to Apple. Apple currently trades for 8 times price to revenue multiple. In the bear case, I go with a 5 multiple, and in the bull case, I match Apple multiple and I go for an 8 multiple. So Google Devices and Subscriptions in the bear case will worth $200 billion, and in the bull case, this part of the Google business will worth around $320 billion. Next, we have Google Cloud, which had a revenue of $12.2 billion in Q1 2025, and I think it should be able to do $50 billion annually. This is a high growth segment of the business competing with AWS and Azure. It's profitable and it has massive potential. I go for a 6 multiple in the bear case and 12 multiple for the bull case. So Google Cloud in the bear case will worth $300 billion. In the bull case, it will worth $600 billion. For other bets, I only going to consider Waymo, as the other ones are much smaller at the moment. So recently, basically one of the analyst firms assigned a base case valuation of $300 billion to Waymo based on expectations for $100 million in EBITDA by 2030. But I would stick with a conservative $50 to $200 billion valuation for Waymo. So in the bear case, Waymo will worth $50 billion. In the bull case, it will worth $200 billion. Okay, let's do some of the parts and see how much Google market cap is based on the bear and bull cases. In the bear case, the market cap of the Google should be around $1.93 trillion. In the bull case, the market cap should be around $3.54 trillion. The current market cap of Google is $2.3 trillion, which, as you can see, is between these two values. My fair value based on some of the parts is $2.65 trillion for the market cap, which means Google shares are currently trading for an almost 14% discount compared to some of its parts valuation. Okay, let's focus on the second method of valuation for Google. Let me go over the valuation of Google stock using my own discounted future earnings model. To start building the model, I imported a series of general parameters from Google earnings report, like the current share price, their revenue, their number of shares, their net debt, which is their short-term and long-term liabilities minus their cash or cash equivalents, and their diluted earnings per share. I also put my expected rate of return to be 12% for this stock. Now in this model, I will calculate the fair value of the stock by projecting their future earnings and then discount the terminal value and future cash flows minus the liabilities of the company back into the present value of the stock based on 3 different scenarios. In the bear case, or the most negative case for the stock, the business will have a little bit of margin compression. I considered 0% share-based compensation and 1.2% share dilution. I assume they are able to grow their revenue by only 8% in the short term, 6% the midterm, and eventually by only 4% the long term, and I considered a terminal multiple of 16. For the base case or normal case, I considered a little bit better margins in line with the current margin of the business. a normal revenue growth in line with analyst expectations, and a terminal multiple of 21, which is close to its historical multiple. Finally, in the bull case, or the best possible outcome, I considered a little bit better profit margin with margin expansion, only 0.8% share-based compensation, a 12% short-term, 10% midterm, and 8% long-term growth, and a terminal multiple of 26, which is a relatively bull multiple for this company. Now, if I hit calculate, the software will give me some valuable information about this stock based on my assumptions. It gives you the intrinsic value of Google in each scenario, and then it will provide you with a fair value estimate, which is $219 per share for Google, and compared to the current share price of $119, Google trades at 15% discount today. It is a buy according to the model. If you believe the assumptions in the bear case, then the stock can be expensive. If you believe in assumptions in the bull case, the stock is extremely attractive and undervalued. So it all depends on your expectations. For me personally, I own 100 shares of Google in my RRSP account, and I believe in the company for the long term. I think Google stock is undervalued here, and it is attractive based on both methods that I mentioned, sum of the parts and discounted future earnings. Based on both of them, it was undervalued. But I don't think this is a generational buying opportunity. It is a great foundational company, and I think it's hard to lose money with Google at these valuations. Based on these different scenarios, it is a low risk, high reward investment, and I continue to hold my shares for foreseeable future. But again, this is not like the Google is extremely undervalued, or this is a generational buying opportunity. There you are, guys. I hope you enjoyed the video. Thank you for watching the video, and I see you guys in the next video. Farewell.